Well, US markets are set to close in the red, the S&P breaking a 7-day winning streak. Despite that, the market is up 18% for the year to date. That's its best year since 1997, when the market rose 25%. Now we're joined by Derek Orth of Brendan E. Crine. Derek, we have the Fed meeting next week. Have we got to the stage where investors have begun to discount the timing around any cutback in bond buying and focus more on the strength of the underlying economy, or are we still in Fed watch mode?
I think we still are a little bit on Fed watch mode, but everything that the market's kind of priced in what the Fed is going to try to do here going forward. Economic numbers have been coming out, have been a lot better, so that's good. And the bond market and the stock market's kind of been suggesting to us, what the trend is going forward. We had a few weeks back, last time I was on, we were talking about the S&P 500 breaking through a certain zone that I was looking at around 1665, and we did that pretty convincingly, and we kept running through the market, going up. We got around the 1690 level. We pushed back a little bit here. I'm looking around 1681 as an area of support. Going forward, just to see where, if the market momentum can maintain its current move.
Okay, so markets have run very hard. Are there any sectors that still look attractive on a PE basis?
PE basis, well, I do like the technology stocks in general, just technically the way they've been acting. Again, a few weeks back, it was trading around a support zone around 455 in the semiconductor, the SOX, Philadelphia Semiconductor Index, and it held that zone. It filled the gap at around 471 and rallied up from there, closing that gap, negating a bearish downward move, and that just added momentum to the fuel behind that sector itself, and the company's acted really well and started rallying, got up to around 490 zone right here. And we're pulling back a little, but I look at around support, and that is around 481 for an actual gap up move. So that's kind of like an area of support in the SOX.
Okay. And just briefly, aside from gold and other commodities, are there other asset classes which you would expect to suffer if the Fed does cut back bond purchases next week?
Well, yeah, I think gold is getting hammered pretty good today. It's down about 40 points right now as we speak. But yeah, when you're looking at the 10-year and what the Fed is anticipating on doing with bond purchases, you just got to watch that index. I watched the Fed yield, the 10-year yield, basically, and see if there's any volatility in it, any upward movement in price in the yield itself, spiking high above 3 or not. Right now, we're at the 10-year's at 2.9, so we're kind of watching that 3% yield area. And if any interest rate sensitive sectors, if we get a spike well above 3%, we could see some pressure on them. But I think that's kind of anticipated, and we've kind of seen that as a level of stability and a sort of sense in prices in general. So.
Okay, there you have it. That was Derek Orth from Brendan E. Crine, and I'm Jane Searle for The Deal.